Hello everyone, today I'm going to show you my automated discounted cash flow model. The discounted cash flow model is a common earnings model used in many finance classes all across the world, where essentially what you're doing is you're trying to project what a company will earn in the future, free cash flow earnings that is, which is cash flows available to shareholders after things such as depreciation, capital expenditures, and cost of goods and all those goodies there, and then you're going to discount those projected earnings with a sort of discount rate, usually based around the expected risk of the company, to come up with an intrinsic value, what you think the stock is actually worth. So that's the basic idea behind it. There's plenty of other resources out there if you want to learn more, but at this point I'm kind of assuming you at least know how it works. So that being said, let me show you how the automated system works that I made. And I made this in Microsoft Excel using a few Visual Basic scripts to kind of automate the process and make it as quick as possible. Because if you've ever done one of these by hand, it sure takes a long time. So you can download this this file on my GitHub, and I'll put the link in the description. But I'll go ahead and show you how that works. You want to go to my GitHub. You want to click this stockanalyzer.zip, and you want to go ahead and hit this download button. And what that's going to do, it's going to download a zip file. You're just going to want to extract that zip file and open it, and it'll look like this. So there'll be a few folders in here and a few files, Excel files. The one you want to look at is this one, pre-processing macro with modeling. So we're going to go ahead and open that. And then here you'll see an input page. So I'm going to go ahead and delete all this because I was looking at Amazon earlier. And first we're going to think about what stock do we want to analyze, right? So I'm going to use Apple for this example, because why not, right? The largest company in the world by market cap, and I think it'd be fun to see where they're going, or what we think they're worth. So, and I'll preface this by saying, a company as big as Apple, chances are the value is pretty efficient. They're probably worth close to $462 if that's what the market thinks. But we'll see. Based purely off of their fundamentals, what we can kind of determine, and maybe see if things change. If we assume that they'll grow more than the market, how that would affect their stock value. So we're going to need to do a few things here. We're going to need to get their financial statements. And I use this website called SimFin, and it's actually the only website you can use with this system because the way it's formatted, you have to use SimFin. So we're going to go ahead and look up our company, which is Apple, AAPL, and we'll see their financial statements right here. Well, these ratios and whatnot, but the financial statements are down here. Just go ahead and hit this download button, and then we're going to hit CSV, and we're going to download that file. We're good there with SimFin, and then you need to get a couple other files. So we need to go to Yahoo Finance. We're going to need to get some stock data. So let's go to AAPL, and then we're going to look at historical data right there. We're going to need a 5-year look back. So let's go and click this, hit that little 5-year button, keep it at daily for the frequency, hit apply, and hit download. Alright, and then we're going to get the S&P 500 data. You could use another index, but S&P is usually the index to use, especially with large cap stocks like this. Could use an NASDAQ, but we're going to use S&P. So historical data again, keep it on daily. Let's change this time period to 5 years. Hit apply and hit download. Alright, so you have those files. You can change the names if you want, but whatever you name them, just make sure you remember what you name them. And then we're going to bring those files into some of these folders. So the input files we're going to put in the financial statement. And I'm actually going to delete all these. So we're going to put in SimFin Apple. I renamed it to SimFin Apple. And then stock values, again, I'm going to delete all this and put in the Apple 5-year look back and the S&P. Alright, so we have our financial statements and input files and our stock values and stock values. Let's go back to our model here. Okay, so we're going to need to call those files. So we need to tell Excel to pull in the proper files. So in input files, we have the name of our financial statements is Sinfin Apple, so we can just copy that, put it in right there. And then we're going to look at the stock values. We're going to take the the Apple APL file name, put it in that second line, then S&P. You can type it in, but I'm just copy and pasting. Make sure I get it right, right there. And then we're going to need to look up a few more inputs here. So we're going to need to look up the 10-year T-bill rate. This is going to be our risk-free rate. So, as part of discounted cash flow model, we need to have a risk-free rate to calculate the CAPM, which is capital asset pricing model. So, to get the risk-free rate, I use 10-year Treasury rates. You can use, another reasonable rate, but let's look up 10-year Treasury yield. Okay, it looks like it's 0.68%, which is a historic low. Thanks to the pandemic that we happen to be in right now, keeping those rates nice and low for us. And then the next thing we need is the stock's 10-year bond rate, which is going to be essentially your cost of debt. And again, you can use other ways of valuing cost of debt. I like using the 10-year bond rate for the stock. So we can go ahead and Google that. Let's see what we can find. This looks like I don't like it. Well, I see 4.25 right there. I think that's 30 years, though. Okay. Yeah, okay. June, this is 7 years, 3%. Yeah, let's go with 3%. We can always adjust it, but let's just go with 3% right there. Let's make it a little bit higher just to be on the safe side. With the perpetual growth rate, I use 2% usually. This is going to be the rate of perpetuity. So after our forecast years, we're gonna, we have to come up with a rate that we think the company will grow indefinitely. So I picked 2%. And then our forecast for years, this is how many years we want to look into the future. So I'm going to say 5 years, which is pretty typical. You could go to 3, you could go to 2, 1, or, well, probably not 1. But maybe 3, 4, 5 are good numbers. And then shares outstanding, you want to look this up as well. So it's for Apple shares outstanding. Okay, so we have 4.276 billion. You want to put this in as millions, so I'm going to go 4.276. All right, perfect. Now, the rest of these fields, if you leave them blank, then my macro will actually calculate them for you. However, I usually look up the stock beta just because the Excel calculation for beta doesn't always match what I find, and I tend to trust the internet a little bit more than Excel, at least for calculating beta. So it's usually pretty close, but let's just use what we find here. So I have 1.23 for Apple. Yeah. And then the rest of these, if you leave them blank, then the system will use CAGR, which is compounding annual growth rate, and it will actually look back from whenever the beginning of the financial statement is. So, we can check that out if we open up the Sinfin file. Yeah, looks like Apple's 10 years. So it's going to do a CAGR from here to here. It's going to look at the revenue, or whichever field, 10 years ago and determine what the growth rate is if you compound it annually. And then it'll push it forward for as many forecasting years as you put in. If you don't want to do 10 years, and you want to do 5 years because you think that's more relevant, you can change it. Just, literally I will just copy and paste it and then delete this. There you go, 5-year forecast, or 5-year look back. And I'll do that because I think that's probably a little bit more reasonable. Okay, so we'll do 5-year look back, 5-year forward looking. Rest of these will let CAGR, determine our destiny, at least in the first try. Let's go ahead and hit run. Okay, so we're going to see a few things here. This first tab that you're looking at is the PL. That's the profit loss, also known as the income statement. We're going to see, revenue. This is, taken straight from our input file. But then we have some forecasting right here. So it's forecasting revenue, cost of revenue, gross profit, operating expense, and operating income. Using the compounding annual growth rate, so we can see, it looks like it's going forward at about the same rate as it is going backwards, which is pretty cool. And you can adjust that, so we'll see our rates right here. You can change these if you want to. If you're a little bit more optimistic on Apple, you can change this to 5. You can change it to 10. You can change whatever you want, and then just rerun it. So let's check out the balance sheet. Balance sheet, there's no forecasting there because you don't really need to forecast balance sheet for DCF. A lot of professionals might disagree with me, and that's fine. As in depth as you want to get, you could forecast some of this. If you want to try to calculate taxes in a better way or what have you. But I'm just gonna keep it how it is. I'm trying to keep this kind of simple and agnostic as I can. And then we have cash flows right here. Again, we're only calculating or forward-looking on the things that we need for DCF. Depreciation, amortization, change in working capital, and change in fixed assets and intangibles, which is used for CapEx. And we're just using CAGR to push these forward. Then we have the beta tab here, which is where the stock historical value is located. We have our S&P values for 5 years listed back there. We have our Apple values. And then we have our daily changes in S&P and our daily changes in Apple. And then here we have S&P annual performance. This is where was the market a year ago compared to now, and what's the rate and change. I use this to calculate market premium for CAPM. And finally, with our discounted cash flow tab. So I'll take you through this. We have the perpetual growth rate just brought in from our assumptions, our beta, which is brought in from the assumption or could be calculated if you left it blank. Expected market return, which is an average of the annual returns on the S&P every day. Risk-free rate, that's our T-bill rate. And then CAPM, which is the capital asset pricing model. That's going to be our cost of equity. Cost of debt, that's 3.15. That's our 10-year bond. The weight of equity versus weight of debt, which is just taken straight off the balance sheet. Tax rate, that's calculated for you automatically. We have it up about 16%. And then WACC, which is 5.49. You might think that's kind of low for a WACC, and you'd usually be right, but we're in a pandemic right now, and debt is cheap, so that's what we get. You could adjust that by changing your assumptions and your inputs, but by default we're getting 5.49 in WACC. And then finally, we have enterprise value, which is in millions. Millions. So 2.12 trillion. That's what we have for enterprise value. That's pretty close to the market cap. So, that's where we're at. And then here you see the actual discounted cash flow model. It's looking 5 years into the future. We have after-tax operating income, looking forward, depreciation, capital expenditures, change in net working capital, and our free cash flow right there going forward. Looks like they're going to dip a little bit based off our current assumptions. And then we have a perpetual growth rate of 1.533 and enterprise value over EBITDA. These are two separate terminal values. Perpetual growth rate just uses our perpetual growth rate of 2% and pushes cash flows forward to perpetuity. Enterprise value over EBITDA takes the enterprise value and divides by EBITDA. So you might use one or both. I use both, and I average them to 1.652 for terminal value. And then we have intrinsic enterprise value right there, which is 1,517,000,000, which is going to be the enterprise value after our DCF. And intrinsic equity, which is taking enterprise value, taking out the debt, adding back into cash to see what the actual stock is worth. And then we divide by shares outstanding to get $320 for intrinsic stock price, which is pretty far from the current stock price. So, you might think, okay, well, maybe we're being a little bit too hard on Apple. Let's change some of our assumptions. Okay, we don't, we might not think the revenue is going to drop or only be 2%. We might think, it's pandemic, tech is, the way to go. Let's at least raise their revenue to, let's say, 7. COGS might have to increase a bit, so we'll make that 5. Keep everything else the same for now. Hit the reset model button, hit run again. Okay, DCF, what do you say? $606. So that's a great example of how fragile the DCF model is. Little changes in inputs can have crazy effects on the outputs, especially when you're talking about revenue versus COGS. So, I mean, that's pretty much it, though. So, a couple other things. The special columns names, you most likely will never have to touch this. Some companies have different names on their P&L and CF. So, like, revenue, cost of revenue. They might say something else, like cost of goods or whatever. If it does, just change the name here and it'll work just fine for you. And then other than that, so you hit the Save Extract button to save it. Hit yes here, and then it's going to save this for you in a non-macro workbook, so you can do whatever you want with it there. Macros will no longer work. After you hit Save Extract, though, hit reset, it's going to give me an error. Oh, actually it didn't. Well, there. It won't run it if I hit run. So I'll close that. And then let's take a look here. So it's going to also add our stock value into this list for you. So if you do multiple of these, it'll create a nice big list of all your valuations and or all the current prices, the intrinsic prices, and the difference. And whenever you uploaded it, and it'll put your pre-processed file right here. So if you want to go back and see what you valued Apple at on 8/19, you just go back into the output file, and there you go. So it's saved there, nice and formatted nicely for you. And that's it. So I hope you get a lot of value out of this. I hope you find it useful, and I'm open to any sort of suggestions to make it better. Like I said, I want to keep it pretty simple and agnostic, as to eliminate any inherent biases, which is hard to do with DCF in general. But yeah, I hope that you get a lot of value, and everyone have a great rest of your day.